Today, something unsettling is happening beneath the surface of the market. It's not obvious, it's not dramatic, it's not the kind of thing you'd see in a breaking headline, but it's there, quiet, subtle, and eerily familiar. It feels like a mood of 1999 when optimism blinded investors to obvious risks, like the calm of 2007 when early cracks appeared while the market kept rising, and like the inflationary confusion of the 1970s when numbers look strong on paper but weak in reality. Right now, the market seems stable. Stock indexes push upward. Tech giants report record profits. Investors regain confidence, and many believe the worst is behind us. Yet beneath this polished surface, the foundation is weakening. It's not collapsing, not yet, but shifting, bending, and creaking under the weight of deeper economic pressures. In this video, we're going to examine those pressures. We'll break down the hidden forces holding up the market, the early warning signs that most investors overlook, and the deeper cycle that explains why today feels so strangely familiar. Because markets don't fall when things look bad. They fall when things look too good to question. Let's begin with the illusion of strength. At a glance, everything appears healthy. Consumers continue spending. The unemployment rate looks low. Corporate earnings show strength. And many investors feel confident enough to take on more risk. But surface numbers don't tell the real story. Context does. And the context today reveals a very different picture. Household savings, once temporarily boosted by pandemic-era programs, have disappeared, not declined. Disappeared. Many families no longer have financial cushions. They rely on credit cards, short-term loans, and paycheck-to-paycheck cycles. Savings accounts have become emergency accounts, drained the moment money arrives. Credit card balances reach their highest levels in American history. Auto loan delinquencies are rising at a pace not seen since the last financial crisis. The cost of housing, even for renters, has skyrocketed, and wage growth has consistently lagged behind inflation, leaving households stretched thin. This isn't long-term strength. This is financial fatigue, disguised as resilience. But here's the strange part. Even with all these pressures, the stock market keeps rising. So the obvious question becomes, if consumers are struggling, if companies are tightening, if valuations are extreme, why is the market still climbing? The answer lies in three hidden forces, powerful enough to hold a market together, but fragile enough to snap without warning. Let's start with the first, government-supported demand. Many people believe stimulus ended years ago. No more checks, no more direct benefits, no more emergency packages. But stimulus didn't vanish. It changed form. The government collects around $5 trillion in tax revenue, but spends close to $7 trillion. That extra $2 trillion flows back into the economy in countless unseen ways. Government contracts to private companies, infrastructure spending, corporate subsidies, expanded credit programs, defense and manufacturing investments, and support programs for industries under stress. This creates a financial floor beneath the economy and beneath the stock market. Corporate revenues appear strong, not necessarily because consumers are thriving, but because government spending continues to fill the gaps. But this floor comes at a cost. The national debt now exceeds $38 trillion. Interest payments alone surpass $1 trillion each year. That means the government borrows money just to pay interest on previous borrowing. This is not a sustainable cycle. It's a system held together by momentum, and momentum can reverse quickly when confidence fades. Now let's move to the second force, dollar weakness. This is one of the most misunderstood factors in today's market. When the dollar weakens, almost everything becomes more expensive, from food to cars to services to raw materials. Companies respond by raising prices. Revenues increase, earnings increase, stock prices follow. But this is not real growth. It's inflation wearing the mask of prosperity. A company doesn't need to innovate or sell more products to show impressive earnings. It only needs the currency to lose value. Investors see rising revenues and think this company is thriving, but in many cases, the only thing growing is the price tag, not the demand. This pattern is nearly identical to what happened in the 1970s. Markets rose for years not because businesses grew sustainably, but because inflation distorted the numbers. When inflation finally broke, the market corrected sharply. Dollar weakness is like a rising tide that lifts every boat, but the tide isn't water, it's erosion. And when it recedes, the shoreline changes dramatically. Now let's turn to the third and most dangerous force, cracks forming in the credit system. Credit markets are the invisible plumbing of the financial world. When they function smoothly, the economy flows. When they break, everything stops, even if stock prices haven't reacted yet. Recently, several funds tied to risky loans began freezing withdrawals or collapsing entirely. At first glance, each incident seems isolated. A troubled auto loan portfolio here, a stressed commercial real estate trust there, a private credit fund quietly closing its doors. But this is exactly how 2007 began. A fund failed, then another. Investors demanded their money back. Banks tightened lending. Liquidity vanished. Confidence evaporated. And the downward chain reaction accelerated far faster than anyone expected. Today, the warning signs are similar. Auto loan delinquencies climbing. Commercial buildings losing value. Private credit funds struggling to meet redemptions. Banks reducing risk exposure behind the scenes. Liquidity shrinking in key parts of the financial system. These are not catastrophic failures. Not yet. They are hairline cracks. Small, quiet, easy to ignore. But cracks always appear before the break. And here's the part most people misunderstand. Markets don't crash because of bad news. They crash because confidence breaks. Bad news is expected. Bad news is priced in. Bad news becomes noise. But a sudden loss of trust, even from a small event, can trigger a chain reaction far larger than the event itself. All it takes is one unexpected shock, one fund freezing withdrawals, one company missing earnings, one bank announcing liquidity trouble, one failed bond auction. Confidence is fragile, and once it snaps, markets move violently. This is the stage we're in today. Not the crash, not the panic, but the numbness. The period where investors stop reacting to negative information because the market keeps rising despite it. This happened before the dot-com crash, before the housing crash, before every major downturn of the past 50 years. Investors grow comfortable. They stop questioning. They stop preparing. They'll believe the market will rise no matter what. And that belief is always shattered suddenly, not gradually. So where does this leave us? We now have three forces holding up the market. Government-supported artificial demand, a weakening dollar inflating corporate profits, and silent cracks in the credit system. These forces can delay a correction, sometimes for months, sometimes for years, but they cannot eliminate it. Markets built on temporary support eventually return to fundamentals. The longer the delay, the more dramatic the adjustment. This isn't about predicting a crash. It's about understanding the framework. It's about recognizing the difference between real strength and artificial support. And it's about staying prepared when most people grow comfortable. If you want clarity in a noisy market, if you want perspective when things stop making sense, if you want to become the kind of investor who survives cycles instead of getting crushed by them, stay with us. Stay smart. Stay focused. Stay invested.